Last time we have discussed comparable multiples. Multiples are one of the simple valuation approaches that allow us to quickly get a rough idea about how much a company is worth. Next, we are going to discuss the discounted free cash flow model. The DCF model is a sophisticated approach that gives the analyst full discretion over modeling the expected future of the company. Due to its versatility and the right focus on the value creation, it is the most popular model to value non-financial companies. The key input to this model are the free cash flows that are also sometimes called the free cash flow to the firm. At the following lecture, we will discuss how to understand free cash flows and how to forecast them. It is helpful to start with developing intuitive understanding of what free cash flow is and how it can be interpreted in different contexts. I will argue that there are several ways of viewing or understanding free cash flow, and being familiar with these different perspectives may be useful in different contexts. When it comes to forecasting, free cash flow is certainly a cash flow concept. However, to forecast it, we will use financial ratios that are defined in terms of the balance sheet and income statement numbers. We will discuss why these ratios are the best way of forecasting this cash flow concept. The label free cash flow includes the word free. Therefore, the first question to ask is what this word free refers to. Investopedia defines free cash flow as the cash generated by the company after accounting the cash outflows needed to support operations and maintain its capital assets. In other words, every company generates some cash inflows from operating activities. Some of this inflow will need to be spent to maintain the company's business. Free cash flow is whatever is left after that. In the context of budgeting, people sometimes distinguish between mandatory and discretionary spending. Mandatory spending are made for the essentials such as rent or food, and discretionary spendings are made for things or services that are not essential to make the entity running. In the context of company valuation, free cash flow roughly corresponds to the cash that is left after all the mandatory cash outlays have been made. From the accounting perspective, we can say that companies generate some cash inflows from operations. Part of these inflows have to be spent to maintain companies' future operations. For example, the companies need to purchase additional inventory or buy insurance for the upcoming year. Another part of this cash is going to be spent to maintain and extend fixed assets. These will be recorded as capital expenditures or the negative cash flow from investing activities. Free cash flow is whatever is left after deducting the operating and investing cash outflows from the operating cash inflows. Following this line of reasoning, free cash flow can be defined as a sum of cash flow from operations and cash flow from investing. Note that the cash flow from investing will typically be a negative number representing cash outflows, capital expenditures, and therefore the free cash flow will typically be less than the cash flow from operations. From the accounting class, you know that the sum of cash flow from operations, cash flow from investment, and cash flow from financing is equal to the change in cash on the balance sheet. But that implies that there is another way of defining free cash flow, as the change in cash on the balance sheet minus the cash flow from financing. This expression represents another perspective of looking or interpreting free cash flow. Free cash flow is the cash that is paid out to the capital providers, that is to say the owners or the creditors, plus the cash that the owners and creditors kept in the company in the form of cash. Now, for mature companies, typically the level of cash on the balance sheet from one year to another does not change much, and therefore this number will be close to zero. And in such a case, the free cash flow will be very close to the negative of the free cash flow from financing. That is to say, that it will be the cash flow that is free to be distributed to the external capital providers, those who provide debt and equity to the company. Now note that there is a minus sign in front of the cash flow from financing. You can think through why this minus sign is included and what it represents. And this brings me to the first question. The question asks you to discuss the fundamental meaning and advantages of free cash flow. So first of all, please discuss what free cash flow actually is. Then discuss how it is related to the individual components of the statement of cash flow and the individual components in the income statement. That is to say, draw logical links between the free cash flow and whatever you find in the statement of cash flow and in the income statement. Finally, I want you to discuss the advantages of free cash flow in company valuation. Free cash flow has some desirable characteristics which imply that it is very often used to value non-financial firms. I want you to discuss these characteristics and explain why it is the free cash flow that is discounted rather than, for example, net sales, EBIT, net income, or any other number from the income statement or balance sheet. In a related multiple choice question, I put forward several statements concerning free cash flow, and I want you to identify the one that is not correct. In doing so, please pay attention to all the other statements that are correct and notice what message about free cash flow they actually convey. After having understood what free cash flow is, we will discuss ways of forecasting it. Even though free cash flow is inherently a cash flow concept, we will forecast it using financial ratios defined in terms of the income statement and balance sheet numbers. You can ask yourself why that is the case. That is to say, why don't we just take historical cash flows from the statement of cash flow, prolong some trends, and use those to forecast free cash flows in the future? Second, note that the ratios we will be using for forecasting free cash flows coincide with the ones we have used to analyze the company's historical performance. This is another reason why it is essential that the financial ratios are defined consistently and they properly distinguish between operating and financing components. Forecasting free cash flow will take place in 3 steps. First, we will forecast EBIT, that is to say, the net operating income before taxes. EBIT represents resources that will be distributed among 3 parties: the company's owners, the creditors, and the tax authorities. In the second step, we will need to adjust EBIT for taxes to generate the net operating profit less adjusted taxes. The tax adjustment is needed because if a part of EBIT is paid to the state or the tax authorities, then of course it is not free to be distributed to the capital providers, and therefore it should not be a part of the free cash flow. In the third step, we will adjust NOPLAT for cash outlays that are made to maintain operations and make investments in fixed assets necessary to keep the company running in the future. These cash outlays will not be reflected as expenses in the income statement, and therefore they will not be reflected in EBIT. And therefore we will need to make adjustments for them. So in other words, what we do in these 3 steps is that we convert a before tax operating income number to a after tax operating cash flow number. And this brings me to the last 2 questions of this week. The questions are related to the first step of forecasting free cash flows, that is to say, to forecasting the earnings before interest and taxes, EBIT. To forecast EBIT, you will need 2 financial ratios. I want you to first specify what these ratios are and how can they be used to estimate future EBIT. That is to say, what computational steps do you need to perform to obtain EBIT with the use of the 2 financial ratios. After that, I want you to discuss the economic forces or factors that shape them and that a rational financial analyst should keep in mind when forecasting them. And in a related multiple choice question, I give you a choice of several combinations of 2 financial ratios that may be used to forecast EBIT, and I ask you to pick the combination that will indeed be useful in the first step of forecasting free cash flows. And that brings us to the end of this week's lecture prelude. This cartoon nicely depicts that anything that is related to value creation and therefore affects firm value must be related to one of the 2 value drivers, that is to say profitability or risk. Or in other words, it has to affect the free cash flows or the cost of capital of the company. So if somebody comes to you and talks about a company that has bright future and many orders from the customers, you should always ask how these orders are going to be translated into revenues, how these revenues are going to be translated into profits, and how these profits are going to ultimately become future cash flows.